Hello, everyone. Welcome to the latest edition of LPL Market Signals. Jeff Bookbinder here, Chief Equity Strategist, joined by my friend and colleague, Mark Zabicki, Chief Investment Officer and Director of Research. How are you today, Mark?
Doing well, Jeff. Great to join you here on a Tuesday, actually.
Yes, we are recording this Tuesday morning, September 6th. Looked like when we came in, we'd have some gains today, but those unfortunately have evaporated, at least at this point in time. Late morning as we're recording. Here's what we got for you today. A lot to talk about. It's just a really interesting market environment. We titled today's podcast, Odd Reaction to Goldilocks Jobs Report. Right? We thought this report was pretty much right what the Fed wanted to see, but clearly the market has other ideas. So we'll talk about the jobs report, what it means for markets, and our thoughts on what may happen here going forward. And then the third item on our agenda is we're making some changes to the asset allocation, the tactical asset allocation for LPL Research. So we'll talk about some risers and fallers for our tactical asset allocation committee. These are not just things that are working, these or not working. These are things that we think are starting to look better or starting to look worse, where our views are changing. So let's get rolling here. To start, was Friday's job report what the Fed wants to see? I would argue yes, and it was really interesting, Mark, the way the market reacted, right? Initially, stocks popped on the news. It looked like pretty much every component of the report was dovish for the Fed, and yet stocks went down. Did the market read it wrong?
No, I think the market is reading not necessarily what a jobs report says or what the economy says. I think the market's probably gone back now to reading, is the Fed going to engineer a soft landing or is it not? So I think the market trading, and we'll perhaps get into August trading versus trading that happens after Labor Day, which we're now day one in that. But the point is I think the market's just revisiting the previously held notion that the Fed was going to be kind of be a little bit more dovish and perhaps have a higher probability of engineering a soft landing, where obviously the conversation in Jackson Hole has changed that narrative just a little bit. And I think I'm probably one that would say I probably didn't matter what the number actually looked like on Friday. I just think the market is actually reading it negatively at this point. That could possibly change though, but I think that's where we were on Friday.
Yeah, I think that's right. There was really nothing in the jobs report that made the situation any worse for the Fed. Our chief economist, Jeffrey Roach, did highlight that temporary workers reached an all-time high. And so when you have a lot of temporary workers, they can more easily be cut in a downturn. So that maybe puts the labor market on slightly weaker ground. But if you just go through all the pieces of this and you're looking here, for those of you watching on YouTube, you're seeing the trend in jobs, right? And what the Fed wants is less job creation. They won't admit it, but that's what they want to cool wage pressures. So we got that, right? We got a couple 100,000 jobs less month over month. Not only that, but we actually chopped off about 100,000 jobs from prior months with the revisions. So that is certainly dovish. We had the unemployment rate tick up just a bit. Not only do we want to see fewer job openings to put downward pressure on inflation, we need a little bit more unemployment. Not a great position to be in, but that's the position we're in. The wage gains were a little less than anticipated by economists' consensus. And, it's not great, 5.2% year over year, but it is starting to move in the right direction. And then the yield curve steepened. It's steepening further today because the long end of the yield curve is moving higher. And that's positive. So, I agree with you, Mark. The market just wanted to go down. It wanted to test some of these technical levels that we'll talk about in a minute. Another positive, participation came up. Jeff Roach, again, pointed this out in a blog last week on lplresearch.com. The 45 to 54 cohort of the labor force actually has seen participation go back above pre-pandemic levels. So that's my cohort, and we'll call it your cohort too, Mark. Even though you might be kind of on the edge there, it's always good practice to tell the boss they're young. So 54, 45 to 54 that's an important piece, right, of the labor market. Obviously, the younger pieces are very important too. And everything's really moving in the right direction, except for this older cohort, right? There's been a lot of talk about early retirements among the 55 and up crowd, and you see that in this chart, the gray line moving down. So it's going to be tough to get some of those folks back into the labor market at this point. But the majority of the labor market, we're talking about 75 to 80% participation rates. That's actually not only a good trend, I mean, it's a pretty good level, getting near those pre-pandemic highs for those segments as well.
I think I wouldn't be surprised, actually, Jeff, to at some point see that light gray 55 and over cohort to tick up, perhaps. I mean, I think it just really depends on the overall wealth effect, whether so call that housing prices, call it equity markets, and obviously housing prices still rise, but not to the degree they once were, and then we've had a choppy equity market through the balance of 2022, so that may affect some things as well. So yeah, I mean, you would like to see higher participation rate overall, but that's a decelerating trend that we've been recognizing now for multiple years.
Yeah, certainly these trends are positive, but we do have a little bit more work to go. And but more participation means less pressure on wages, and a happy Fed. So the jobs report, we were really looking for that report to help stocks gain support around this 3,900 level that we're breaking right now on an intraday basis, right? Again, I'm calling this thing Goldilocks. Relative expectations, it was Goldilocks, but the market just wanted to go down. The fact that we had a fairly Goldilocks report doesn't take away from the challenges that we have in Europe, right, which are getting worse, not better. We'll talk about that more in a bit. Doesn't take away from the fact that inflation is going to take time to come down, even though a lot of these inflation indicators are moving in the right direction. Inflation, that problem won't be solved for many months at the earliest. So the market has to be patient. And if you're looking for, a panacea, it's really not there. But certainly this was a positive step to, all of those items that I listed off in the jobs report that looked good and are moving in the right direction. But, this 3,900 level mark is really, and it's got significance for a number of reasons. I mean, you're more of a technician than I am, but I understand from talking to Barry Gilbert that there's a Fibonacci level around here. I think it's a 61.8% retracement level. That's in addition to, these sort of May lows and June highs, right? A lot of technical significance right here. So maybe that means the market was just trying to test that 3,900 by selling off this morning to see, how firm the ground is underneath this market.
Yeah, I mean, no question. I think we'll see how we close today, which will be the important level to watch as far as we're concerned, and then maybe how we close over the next couple of days. But I mean, we have an opportunity to bounce off a 3,900 level support. I guess that would be the hope in terms of to see further equity market gains, kind of building off of some of the momentum we started to witness back in July. And I still think there's an opportunity for that. I mean, if you take a look at things from a calendar perspective, Bookie, you and I have been doing this for quite a while, and I've tend to really not spend a whole lot of time worrying about trading activity in the month of August. I mean, it's not something that you can kind of disregard, no question. But as people are all on vacation, markets are trading relatively thinly across the globe. I would look forward to market participants getting back to work post Labor Day, and then getting a little bit more of a meaningful trajectory as to what may happen in equity markets or other risk assets kind of going forward. So we'll see what post Labor Day brings, and then we'll see if we can't bounce off that 3,900 level on a closing basis.
Yeah, this is an important level, but I mean, there's not a ton of room between where we are now and those June lows. So, if you think those June lows hold, and we think the odds favor that, certainly, we don't have a crystal ball, but if you think the June lows are going to hold, then this isn't a bad entry point for folks who are maybe positioned more conservatively than they want to, or maybe we're regretting missing out on the buying opportunity in mid-June. This is starting to get a little bit more interesting for value players. The other thing I wanted to mention about this recent sell-off is it looks exactly like 2011. A lot of people are trying to draw comparisons between this market and 1970, which actually makes some sense. But if you look at what happened in fall of 2011, we had a 17% rally, just like we did between mid-June and mid-August. Then we had a 10% correction in November of 2011, just like we have right now. We're down about 10% right now off these highs from mid-August. So maybe that pattern holds, and we can just get that same correction we got 11 years ago, and then move higher. And that was the resumption of the bull market that went all the way to the end of that decade.
Yeah, I tell you, Jeff, I mean, we're prone, probably the market participants are generally prone to some, kind of irrational activity, perhaps, as we all look to gauge expectations around, future Fed policy. I mean, I'm going to lean on the fact that, the Federal Reserve is likely going to be, at least in my view, a little bit more dovish than perhaps that we've built in terms of expectations over the last couple weeks. Frankly, I think they can't afford not to be a little bit more dovish than perhaps, again, we've been pricing in over the last couple weeks. So there's that. I think that. I think at the end of the day, not that the Federal Reserve is going to be necessarily successful at engineering a soft landing, but I don't know that they're going to engage in the type of ultra tightening policy that they seem to indicate, in Jackson Hole, or at least, Powell indicated in Jackson Hole. I would kind of chalk some of that commentary up to a little bit of jawboning that he may have been entertaining. So there's that as well. So we'll see what September brings. We'll see what a balancing of rational expectations around the Federal Reserve brings. But I would say you're right, Jeff, in terms of the June lows being a nice spot to certainly get support if we don't get it here at 3,900.
Yeah, absolutely. That would be a 23.5% peak to trough decline if we match those June lows. Given this environment, macro environment, that seems like it's pricing in a fair amount of the inflation problem and the economic growth problem. We'll of course see. So we have another challenge. In addition to the macro, we have the calendar, which you alluded to a little bit, Mark. September is the weakest month of the year historically. Whether you look at 10 years, 20 years, or even 70 years, which is where this data set starts, it's the worst. The only way you make it not the worst is you look at midterm years, and you actually have a worse June. We certainly lived up to that with a rough June this year. The average over the past 20 years is about a 0.6% decline, so not a huge decline, but it does rank 12th, and certainly is getting a lot of attention in the media, people thinking that this might be a reason to be a little bit cautious in the near term. So it's another headwind, but we wouldn't necessarily put too much weight on a seasonal pattern. I guess what maybe is more worrisome than that Before I get to the good news, more worrisome than that is when you have a year-to-date decline heading into September, like we do this year, you get worse Septembers. September on average is down over 3% in that scenario. So there's another reason to potentially be concerned. But if you look at the right side of this chart, look at what's next. October, November, December, 3 of the best months. In fact, in midterm years, those are the 3 best months. You, on average, get gains of nearly 3% in October and November in midterm years, and then another 1.2% gain on average in December. So we would certainly take that if we can get it. That, of course, starts the famous 6-month, sell in May, go away, the 6-month seasonal period starting in October that has historically been really strong. So there's good news. It's coming. What are we, 24 days away from ending September? Hopefully it's an unusually strong September. But once we get to October, we'll have that seasonal tailwind with us. So this is our last segment, risers and followers. I kind of feel like this is a fantasy football show now, where people are talking about who to draft and who's on the rise and who's falling. But we won't talk fantasy football, even though it's draft season. We're going to talk about ideas that we increasingly like, or are increasingly cautious on. And there's a few ideas here. Some of them probably won't surprise you regular listeners out there, but and some of them might be a little bit new here, and even surprised me, one of them, after we dug into it and made the case in our asset allocation committee. So let's start with developed international as a faller. I mentioned, Mark, you're more of the technician. But when I look at developed international from a fundamental perspective, I get really worried. You have, the gas flows into the Eurozone now have been cut off completely. They were at 20% capacity. And Russia's saying they're shut off indefinitely. Germany in particular is just not ready to not have access to any Russian gas. That the inflation outlook over there is getting worse. It's why we may get a 75 basis point hike out of the ECB this week. That's on Thursday. So, the fundamental picture is it's really tough to find anything, frankly, to like in Europe. But walk us through the technicals. When you look at this, so we got, an RSI is certainly down and maybe it's oversold, but you have this relative strength trend, which is the second panel, the middle panel. Relative strength trend is negative, and you've got some deterioration in the percentage of companies above their 200-day moving averages.
Yeah, Jeff. The technicals are almost self-explanatory here. It really the technical analysis 101, lower highs and lower lows. It kind of tells you the story of developed international. So the trend is not your friend here, and I'll second your comments on the fundamentals. I think that's probably the key driver, just the ongoing uncertainty about how Vladimir Putin is going to handle his key customers in Europe in terms of gas supply. That's going to be an ongoing albatross around developed international markets as far as we're concerned. So and that's probably not going to be resolved anytime soon. So as long as that albatross is hanging around the neck of developed international markets, specifically as it regards to the relative activity between developed international and U.S. markets, we continue to be negative in this space. As you mentioned, inflation is continuing to rise, which is problematic. We talked about perhaps the Fed leaning on the dovish side with policy when all is said and done. I think the ECB is certainly going to lean on the dovish side, certainly relative to the Fed when all is said and done. They may take some more definitive action here in the near term. I just think that relative to U.S. markets, developed international is not our first choice here. It is in fact domestic bias in our suggested exposure.
Yeah, we were already negative tactically, and now we've become even more negative. So strengthened our preference for the U.S. The strong dollar is certainly part of it. We'll show you a chart of the dollar here in a second. Really, the same story or similar story anyway for emerging markets, where it looks like just the U.S. is in a stronger position to manage through these inflationary challenges. But in EM, looking fundamentally, you also have the strong dollar is a part of it. Certainly is a challenge for EM, but you also have deteriorating earnings. Earnings in EFA, developed international, have held up a bit better. Emerging market earnings have been deteriorating here for a while, and the downtrend in earnings estimates has been more pronounced in EM. So that concerns us, even though valuations are cheap. That's a reason to to move away. Our view had been neutral, or has been neutral in emerging markets, and we have since turned more cautious as we enter September. So, Mark, as you look at this chart, we were in danger, or are in danger, of breaking support on the developed international chart. Now I look at emerging markets, it looks like it pretty much already has broken support here. What do you see when you look at these charts?
Yeah, more in the same in terms of emerging market, technicals here. Again, the trend is definitively not your friend. We're going to take a look at the dollar, take a look at commodities, and what that potentially means for EM. But yeah, for my money, for a long time, I think this market still is kind of, and almost is funny to say this out loud, I think the market is still correcting from the euphoria of the bricks, right? Whether that was probably the peak was 2007-ish in the brick trade. And now people are just being reminded that the Chinese economy is not infallible. Brazil certainly is not. Russia, of course, is not. India may be the best house in what is a bad neighborhood at this point, just in terms of its go forward ability. But China's not growing at 10% a year anymore. Russia certainly has got its problems. Brazil has got its problems, and I think that it continues to kind of come into play as people rationalize expectations around some of these key countries. And I think we are cheap, as you mentioned, Jeff, but probably cheap in EM for a reason.
Absolutely. Yeah. And the dollar is certainly one of the reasons why it's tough right now to like international. This rally's just been unrelenting. You have 20-year highs. You got to go back. This chart doesn't go back far enough, but you got to go back like 20 years to find the dollar this strong. While that does help exporters outside the U.S. who are selling products into the U.S., that takes time. It's not a great environment for global trade right now anyway. So in the short term, and this is a tactical view, maybe 6-9 months, this strong dollar is a real challenge because it just clips your international returns.
Yeah, no question. And I think if you take a look at what this looks like a little bit of a parabolic nature in the dollar in terms of its trajectory, that may be worrisome to the degree that the dollar could kind of roll over just a little bit and not continue on the parabolic trajectory. But just simply stated, looking at this chart kind of explains what you're seeing on a relative basis in emerging markets, certainly, and then maybe EFA perhaps slightly less so. But the dollar trajectory certainly been a key weight around international equities, and I don't know that changes anytime real soon.
Yeah, you got to probably wait until the Fed slows down, and then it's clear that the Fed is behind the rest of the major central banks in hiking, or further along in its hiking cycle, and then maybe you get some relief on the dollar. The commodities trend has broken. We have actually, on a technical basis, we are downgrading our views of the major commodity groups this month. So, you had this huge correction in June. Copper really led the way down. So Mark, I mean, other than natural gas, it's just hard to find a commodity that really has a good trend right now. What do you see when you look at this chart?
Yeah, I think probably a little bit part and parcel of the inflation story and we've already seen inflation begin to roll over in the U.S. I think the peak of commodity euphoria during the course of that inflation story may have already been passed as well. I mean, if I'm looking directly at this chart and bumping our heads against the kind of the turquoise blue line that you see in front of you, is interesting, and then actually breaking below what could have been support, which is the orange line that you're seeing, is also interesting. Again, I think the commodity trade perhaps may be largely over, and we have been getting probably less so, but we've been getting some questions amongst some folks asking us about how commodities may be the new bond alternative in terms of the overall asset allocation. We wouldn't do that at all. So no, commodities are not the new bonds. We think commodities from a correlation perspective trade too close to the equity market for one thing, and we would not be overweighting commodities here, Jeff, as you mentioned. As a matter of fact, we would be looking opportunities to trim exposure here, and some of the near-term technicals, point to that, and then more broadly, a deteriorating trend in commodities likely is not good for EM broadly.
Yeah, we still like the energy sector. Certainly producers with their discipline and their returning capital to shareholders still look like interesting places to be, but might be a while before crude oil provides much support, still in the 80s. So want to make that distinction. We're talking about hard assets, not energy stocks here. So let's go to a riser. This is the one that surprised me. The technicals and industrials looked pretty good, Mark, even though the economic environment has gotten more challenging. I think, again, starting with fundamentals, it was really surprising to me coming out of second quarter earnings season. Bank of America aggregated capital expenditures data for all the reports, and they were up like mid-teens. So capital expenditures for the S&P 500 growing year over year mid-teens. That's really strong. So there's been kind of this hidden strength underlying this market here, and markets buying industrials when maybe common sense would tell you that that this is a sector you should avoid.
I think you're right, Jeff. I mean, categorically, I think the other aspect of it is, if I think about it as an asset allocator, and you look at where you could be exposed in the U.S. equity markets, do you want to be entirely defensive? Obviously, being defensive has worked most generally of late, but do you want to be entirely defensive, and maybe you want to have a little bit of cyclical exposure just in case that the defensive trade kind of rolls over, and so the question becomes, where are you looking for that cyclical exposure? Is it consumer discretionary? Probably not. Is it materials? Well, that trade has already probably seen its best days, perhaps. So maybe there's a little bit of bottom fishing in industrials, is the way I like to think about it. So yeah, I think if you're going to be somewhat allocated to cyclical groups, industrials may be your best choice as you look across the S&P 500 sectors.
Yeah, absolutely. Nice little uptrend in the relative strength chart. Kind of which of these sectors does not belong, right? It hasn't just been utilities and the other defensives, consumer staples, which we'll get to in a second. It's industrials has been up there in the sector rankings, somewhat surprisingly. So our view on industrials is now neutral after being negative, and we'd be watching closely for an opportunity even to go more positive than that. The last one we have is a faller. It's consumer staples. This is not a technical move at all. In fact, the technicals look pretty good here. I'm sure, Mark, you would agree. But fundamentals, if now that we're down where we're down, if we think we're getting set up for a Q4 rally, you don't want to be too defensively positioned, right? And so We still like healthcare. We still like real estate among the defensive sectors. But we think staples is one to move away from. And the big reason is the cost pressures, right? I mean, it was certainly widely reported the challenges that Walmart had, which is a big consumer staple. When you're not growing very fast and you have cost pressures, it's really hard to offset that. So we would suggest starting to move away from staples because of that impending margin pressure.
Yeah, and the simple math of it, Jeff, is that if you're going to raise our outlook for industrials to equal weight, you got to take money from somewhere, and that certain consumer staples, serves this purpose in that regard. And so there's that, and then there's also, trying to balance the defensive and cyclical exposure in a market that may see some consolidation perhaps through the month of September, before maybe hopefully we move higher during the course of October and November. So to the degree that we've got a market that's still trying to find its way, balancing that cyclical and defensive exposure perhaps is the best way to go.
Yes, I agree. Something else on the seasonality front. If you take the average midterm year performance, the bottom is September 30th. On average. So maybe you don't have to run right into staples today or run away from staples today, rather. Maybe being in defensives for September makes some sense, but we certainly wouldn't wait too much longer than that to start to move away and get a little bit more cyclical exposure. Our view on consumer discretionary is still negative, so we're not suggesting you get cyclical exposure in that sector right now. And then lastly, we're waiting for tech too, waiting for opportunities in tech, but are still kind of cautiously neutral short term. So let's wrap it up, Mark, by just previewing the week. We've got actually some pretty big central bank news, right? We got the ECB on Thursday, and we got Powell speaking on Thursday, in addition to several other Fed speakers. Anything here that you think is particularly noteworthy?
Well, it's really going to be interesting as to what Christine Lagarde does at the ECB. I mean, I don't know that 75 basis points is in the cards from that central bank. I would be surprised if they go 75, honestly. And then will be interesting kind of contrast perhaps on what Jerome Powell says on Thursday. Does he carry forward the Jackson Hole message, or does he kind of walk that back just a little bit? Or maybe the market participants think he walks it back just a little bit. Jobless claims always on Thursday. The ISM number, positive, likely in that you're going to continue to see services economic strength relative to goods economic strength, and Jeff Roach has pointed out a couple of different times now that you're getting that goods inflation rolling over while services inflation still is running fairly hot, and the services activity in the economy speaks to that.
Yeah, this I mean, we shouldn't probably focus too much on 50 or 75. It's just one meeting, right? And what really matters is where they end up, right? And the path of rate hikes and the path of inflation over the next several months. But yeah, if the ECB goes 75, that's going to surprise some folks. That's going to be a statement, right? Because they're normally dovish. And then jobless claims, that's another area. We made that big move. I think we're 75,000 jobs off the lows, roughly, or 70,000 jobs off the lows. And that means that the labor market is slowing and there are fewer openings, and that should help take a little bit of the heat out of the labor markets and out of the wages. So, jobless claims is another piece, not just the Friday job report, but the jobless claims recently have also kind of been right where I think the Fed would want it. So hopefully these all of these central bank comments and meetings will help. There's one in Canada too this week, I think. Hopefully will help the markets get more comfortable with the rate hiking campaign and the inflation outlook, but certainly not something we're going to bet on right this minute. So tough environment. So with that, actually we left off one thing right on the week ahead, Mark, which is the start of football season. So for all of you football fans out there, enjoy the start of football. Well, it's college has already started, but enjoy the start of NFL football. Maybe we'll give some picks next week. We'll see. So with that, we'll wrap. Thanks, Mark, for joining this week for LPL Market Signals. Yep. Thanks to all of you, our loyal listeners, for joining us again. Fun discussion this week. We will see you next time. Thanks so much.